And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Welcome to The Real Investment Show. I am Danny Ratliff here with Matt Doyle.
Good morning.
Good morning. You're listening to the Financial Fitness Friday edition. So today we're going to be on treadmills. You ready?
Let's go.
Walk and talk. It's actually not a bad idea, Brent. I think we should implement that here in the studio, especially after the holiday season. Notice my belt has gotten a little bit wider, but I guess that's a personal problem. Got to work on.
Pecan pie's got to be put somewhere.
Yeah, it's got to be put somewhere. That's the truth. So, lot of information this last week, as expected, and Lance has been talking about for some time. We have seen markets have been a little bit more iffy in the sense of a little bit up and down. We have seen NASDAQ, S&P hit highs. Dow did as well. Market breadth has improved a tad bit as we've seen over the last several months, which is promising. And I think there's a lot of expectations and optimism moving into the end of this year. So with this volatility we've seen, to be expected from the sense of capital gain distributions from mutual funds prior to year end. We're going to get to lighter trading volume over the next couple of weeks as traders begin to take off for holidays, as you guys do as well. So, we should see, and I think we're set up nicely for a Santa Claus Rally. Doesn't mean it's going to happen, but that's what everything is pointing to. Bullish trend is still intact. A little bit of conflicting data over the last couple of days. Inflation's been rather sticky. CPI has been right there, 3.3% once again. Unemployment numbers did tick up a tad bit. Estimates were for 224,000 initial jobless claims. Went up to 242. So a little bit conflicted in that aspect. What we're waiting for today is import price index. And yesterday, PPI was a little bit stickier than expected. So that inflation pressure is certainly still there. I know that's going to be on the agenda with President-elect Trump as far as what do they do, how can they get it done, and how quickly. And combating inflation, if you look back historically, presidents have only so many things at their disposal. And so looking at, do they, increasing, I know we keep hearing the word drill, baby, drill. We are here in the energy corridor of Houston. So certainly some promising things with that. But drilling and production's already been relatively high. What can we actually do with that? We're seeing a lot of countries that are, everywhere else across the globe is certainly slowing down. Look at China. Europe is, they cut rates once again, ECB, another 25 basis points. Expectations for next week, that's what we're watching for. FOMC meeting on the 17th and 18th. What does Powell do? Right now, expectations are for a 25 basis point cut as well. But I think the big thing, and Matt, you can correct me if you think something differently here, is what do they say? That's going to be key moving into 2025. We're going to talk today about a lot of different stuff, but one of the things is forecasting. I'm getting a lot of questions about forecasting. What does 2025 look like? And you're seeing stuff all across the board, but the consensus is relatively high. And so we could see some tripwires out there. And one of them could be the Fed. What if the Fed doesn't cut as many times as expected? And that happened last year. If you can remember back in January, they were talking about 6 rate cuts throughout the year, and then it got pushed back. And then all of a sudden we saw some market volatility in April and May. And next thing you know, they said, well, maybe we're going to do a couple cuts through the end of the year, maybe not. And then we get to July and it's like, okay, we are on that path and we're going to start cutting more aggressively. And that hasn't even been what I think a lot of people were expecting, or the markets. And so when we're dealing with data that they're looking backwards and as data is coming in, it's a tough job. I don't envy their position one bit, but that is something I think that can certainly throw a wrench in this overall optimism, at least maybe short term.
Yeah, I mean, Alan Greenspan famously made the analogy that he would say, hey, we're driving down the highway at, 70 miles an hour, and all we've got to look at is our rearview mirror.
Yeah.
So it takes a lot. And then the Fed's always in a tough spot because they have a dual mandate, right? They have mandate number one, which is keep inflation low, right? And that's controlled through monetary policy and interest rates and things of that nature. And then they have on the other side, their other mandate is full employment. And so naturally, if the economy is at a full employment number, and there you can argue about what is that? Is that 4%, 2%, 6%? But if the economy is at a full employment number and everybody who wants a job has a job, well, then prices are naturally going to start inching up. So, they work opposite each other. The more folks that are employed, the higher wages get. The higher wages get, the more money is spent on objects, going out to eat.
Therefore,
steak
pricing
dinners,
going up.
and then prices go up. So they've got to balance that, and they're always in a tricky spot.
Yeah, and I think, there's a couple ways that you can look at that. You could actually do that with tariffs. I know everybody's thought that it's so inflationary. Michael Leibowitz actually wrote an article about 2 weeks ago on this, is saying, maybe it's not as inflationary as what most people think. If you look at a lot of the think tanks and Tax Foundation, different groups like that, they've come out and said, listen, here's the impact of it, and it's not as consequential as what the mainstream media leads us to believe. However, there are elements of it that can be inflationary, but there can be, from an export perspective, if we're slapping tariffs on imports and other countries retaliate, it's not great for some areas. They're saying U.S. manufacturing should benefit from this, but if all of a sudden they're not selling as much overseas, product prices begin to come down, it can be kind of a balancing act when it comes to overall inflation and what the tariffs look like. But you hit the nail on the head when you said, what about wage growth? And the mandates that the Fed has, that 4% unemployment, 2% inflation, that's a very difficult mandate. I think that's why for so long it was never 2% inflation, it was 3%.
Right.
And so what now has made it that we need to get back to 2% outside of keeping interest rates down lower so that the government can continue to keep the lights on by paying the interest payments on all this debt? And so then you think about what Doge is going to do. Elon Musk, Vivek, are they going to be able to come in and cut nearly as much as what expectations are? And I think that's going to present a significant challenge in the sense of, okay, if you can actually come in and make these cuts, what does that do to economic activity? If you stop this government spending, which is such a large percentage of GDP, if you cut that and you start reducing headcount, what do those unemployment numbers then begin to look like? And can we spark the private sector enough to actually insulate it all from an economic perspective? I think right now we're all looking at, hey, we have a business-friendly administration. We're talking about, deregulating. We just headlines today are, Trump is trying to deregulate banks. Well, there's some good with that, but there's also some bad. And I think that's what got us in trouble back with the financial crisis in 2008. Too little regulation at that point. So obviously lots of things were slapped on to, make sure these types of events did not happen again. And that's where we have to be cautious as well, because there's so many things that are great from the deregulation aspect, reducing red tape. Companies have the ability to put more money to work. I think there's more optimism. Look at National Federation of Independent Small Businesses. That survey was through the roof, right? People are feeling more optimistic now, especially with the potential for lower taxes in the future from a corporate tax standpoint, keeping more money in their pocket. We saw that back in 2018. That was really positive. And that did well for stocks. But right now, one of the things that's really done well, despite kind of what this current administration has done from a business perspective, is that people are buying stocks. We're still seeing buybacks. We're still seeing, right now inflows. We're seeing record inflows into equity markets. And that's going to likely prop markets up for some time until they can't. And so we're seeing this significant optimism. And we're going to talk about this in a little bit when we talk about market outlooks and what that means. We're not the biggest fans of them because they're going to change. That one person that's going to give you that outlook right now is going to change it in 3 months and 6 months and 9 months.
Right.
And it's going to be also, they're going to be looking in the rearview mirror and then they'll be looking ahead. But markets have a tendency to look ahead as well. And so we have to remember that as far as where things are, where we're going. One thing we do want to touch on next is RMDs, especially for those non-spousal beneficiaries. What does that mean? We get a lot of questions, especially this time of year. We've got about 2 weeks left before 2025. Want to make sure you guys have a really good understanding on that. Also, get in the chat. Go to Real Investment Show on YouTube. Happy to answer any questions there if we can as well. We'll be right back after this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff here with Matt Doyle. Thank you guys for joining us this Friday. I know a lot of stuff to do, Christmas gifts to buy, maybe wrap. I know everybody's scrounging. If you're like me, you're trying to figure out what can still get here in time. It seems to be the challenge, right? They're kind of like, oh yeah, we'll get it here by December 24th. I'm like, ooh, I'm not sure I'm willing to place that bet. So anyway, so RMDs, something else we cannot procrastinate on, must be done by year end. So a lot of things we can wait until tax time, April 15th. These are things that we cannot, unless, and we'll talk about this in a minute, unless it's your first year taking required minimum distributions. But really what I want to hone in on right now is non-spousal inherited IRAs. And so this would mean that you've inherited, you are a child, a grandchild, a friend, anybody who is not a spouse. There's new rules when you inherit an IRA. And this has been very convoluted and tricky in a lot of ways because the IRS, issues in the Secure Act back in 2020. We get one new set of rules. Then in 2022, we get a new set of rules. And the IRS has still been trying to determine exactly how they're going to enforce it and what it actually means. So year after year, they've come back and said, you know what, guys, don't worry about it. You don't have to take it this year. But there are some hard and fast rules that you need to understand to make sure that you don't get dinged and penalized. So, Matt, you're hearing about this a lot.
Sure.
Give us the basics from a non-spousal inherited IRA.
Well, okay, so there's, the very high level of it all is, as you mentioned, with the recent changes in the tax code, a non-spouse has 10 years in which they are required to deplete the entire balance of that IRA, whatever the funds are. Prior to that, so if the person passed away before 2020, you were allowed to do what was called a stretch. So you could take that, and there was some caveats depending on what the age differences were between you and the other person and so forth. But for the most part, you could stretch those distributions over your lifetime, and you'd use a factor, and it was calculated. But now there's a crunch to get that money out within 10 years. And what the IRS has done, because the rules, the way it's legislated, weren't exactly clear, the IRS has said, we'll let you skip this year and push it out to next year. We'll let you skip this year and push it out till next year. And so what that does, though, is that if you elect to delay that distribution, what you're in a sense doing is making all your future distributions bigger. So for simple math, if you have $100, you've got to withdraw on average $10 a year. If you delay 5 of those years, right? So now you still have that $100, but now you've only got 5 years left. Instead of withdrawing $10 a year, you've got to withdraw 20. And you can add as many zeros on this to make your example that's appropriate for you. But in the end, that's what you're doing. And what we deal with, a lot of times too is those folks who are inheriting IRAs usually aren't kids. They're not 20, 30, 40 years old. They're a lot of times the parents are passed away in their 80s or 90s, and they're in their late 60s, early 70s, and they're facing their own RMD schedules. They're about to have to start taking money out. And not only that, they're typically on Medicare. And what are the factors that come into Medicare? Well, you've got to calculate what's my IRMA, right? That's going to depend on what your Medicare premiums are. So delaying that, while it sounds like a good idea, delaying those distributions, even though you're allowed, might not be in your best interest. Because what you're doing is you're limiting the amount of time that you have to make those withdrawals and potentially increasing income in future years. The one pushback that I typically get when I bring this issue up to clients is, well, I want to leave it in there to grow as much as possible. And the way I like to think about it is, yeah, well, you can have it grow. You just have to have it grow in a different account. The government wants their tax money. That's all it is. So they're shortening these windows in which these non-spousal beneficiaries have to take out the IRA money because they want to get that tax money. There's a huge balloon of dollars since the 70s that have gone into these pre-tax accounts, and the government's looking at shortfalls and things of that nature, and they're saying, look, we need to do what's equitable. Now, on the spouse side, if your spouse passes away, if your spouse passes away and you leave the IRA to them, they take what's called a spousal IRA. So basically, they put it in their own name, and then they're subject to their own withdrawal schedule. They're not subject to that 10-year rule. So the non-spouse beneficiary is really where this comes to play a lot.
Yeah, and this is the key, right? So when you're inheriting funds that they're not your spouse's funds, you're not taking them as your own, and where you actually will physically move them into an account of your own. Now, there can be some rules if you're under 59 and a half, where you may want to make a distribution if you need funds to live on directly from that specific, from your deceased spouse's funds. And you won't have that 10% penalty. There's certain things that you should be aware of. So I would certainly, if this happens to you, it's an unfortunate event, make sure you talk to your CPA, talk to your advisor, have a very good understanding as far as how this works and what you need to do, because you don't want to be hit with excise taxes from not paying that. It's a pretty hefty penalty. It used to be 50%. It's now 25%. So there is some good with that. But this is something, because for so long, Matt, we haven't had to actually do this, that many people are like, oh, I don't need to do it. No big deal. Right. Well, the IRS actually has come back and said you do. Right. And so when you're looking at this, remember, you're not commingling an inherited IRA with another IRA. You're going to keep that completely separate from your regular rollover IRA. If you have a spousal inherited IRA, you're not going to put those funds into it, because they're going to all have different required minimum distribution ages. Mm-hmm. So while your IRA or an inherited spousal IRA is going to be whenever you turn 73 right now, it's going to go up in 2033 to 75. That RMD is going to have to be taken, and that's going to be on your uniform life table. Whereas if you have this non-spousal, which is a 10-year time frame, that is going to be, if they've already started taking RMDs on their own, you have to take it every single year 1 through 9, deplete it completely in year 10. Mm-hmm. If they've not hit that age, you just have to deplete it by year 10. And so that's what's tricky. I think it's a hiccup for many people. And I think that as CPAs, advisors, everybody's still trying to brush up on it, because unfortunately the information has come out very slow. Last year we were waiting towards the end of the year, mm-hmm. and they're like, well, we don't know quite yet what we're going to do. We're going to let you know. And like in the beginning of the year, like we'll know by mid-year. July was kind of their target date. Then it was September. Next thing you know, it's October. And we're scrambling at the end of the year trying to determine, like, hey, guys, here's what you have to do. But you make a really good point. it may be more beneficial, even if you don't have to take it each and every year, to go ahead and start doing so. Right now we have a great benefit. This tax code is better than one we had back in 2017. So this one, Tax Cuts and Jobs Act, was actually passed in 2017, went into effect in 2018, and it is set to sunset here in 2026. So we have this year and next year we know what the tax code is. Now, President-elect Trump has certainly said, hey, I am going to do all I can to make this permanent. Very slim margins in the House and the Senate. We have Republican senators that are defecting from Trump and fighting him tooth and nail on everything that he's doing. I would continue to expect that. So the pathway to get to it is not as easy as what I think that, most people think. And I'm optimistic that I think something will be done, but will it be attached to something else where we'll have another sunset provision? Will he be able to make it permanent? That would be great. Reducing corporate taxes, keeping this current tax code where it is would be a nice win. And it would give us a longer time frame. That window will open where you can start taking it out very, deliberately. Whereas right now, and we don't know what's going to happen, but we have to think that there is a potential that something is not done. So should you go ahead and start taking these funds out, depending on where you are in your taxes, in your tax bracket, there may be some bandwidth. You may want to, fill that tax bracket up and not go into the next one, but go ahead and utilize it. Don't let any of it go to waste. And so this is something I think that's overlooked often because nobody wants to pay taxes now. And like you said, everybody says, well, I want this to grow.
Right.
And especially if you're optimistic on markets, you think that things are going to continue to go very well. And I'd say we're optimistic as well. But we need to be cautious from a tax perspective as far as what does that mean? How do you play the game to keep as much money in your pocket? And it may be counterintuitive to what we've always been taught in keeping those funds inside of that IRA as long as possible and then depleting it. Because remember, every dollar that comes out, regardless of growth, is going to be taxed at your ordinary income tax rate. And so that is one thing that, you have to start planning for. And it's a challenge because there's a lot of hypotheticals. We're looking at doing Roth conversions right now. And the hypotheticals associated with that, they range. They're quite a bit, right? What if this tax code expires? What if it's permanent? What if taxes get reduced? But the big question is, what can they actually do to reduce the overall deficit over time? Because even if they reduce it now, you got to think that pendulum will swing the other way at some point. And you may in 10, 15, 20 years have higher taxes. And that's what we need to recognize. Now, another thing, kind of talking about a conversion. Now, this is separate from that RMD, but if you hold a significant amount of assets in your traditional IRA or 401k or just qualified plan, pre-tax funds, and you're thinking about what is the impact for your kids, now we're beginning to think about the legacy intent, right? How are they going to best use that? You mentioned, you have a lot of clients in their 60s and 70s. They're coming up on taking RMDs or they're depleting assets because they need to live on them. Mm-hmm. What's the impact if you have that in a Roth? They get those funds tax-free. So think about where you are, where they may be later down the road, and what a nice gift to be able to go ahead and have those taxes done, let those funds grow tax-free. I mean, there's a lot to say about that.
Sure.
So something to think about, a lot of moving parts. We're going to continue to talk about that. A lot of questions we brought up last week or a week or two ago about charitable advised funds and private charitable foundations. So we're going to talk about that, donor advised funds, excuse me. We'll talk about that on the other side of this break, talk about the best ways to use those.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com. The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA portfolio manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Over the weekend, my wife wants to string some lights along the back porch for Christmas. And so I go, hey, you know what? I'll get my son to do this.
The Real Investment Show podcast.
So I said, here, take these strands out there. You and my daughter's boyfriend, y'all go out there and string these lights for them.
Same show, your schedule.
And as soon as they get out there, they unstring the lights. My son steps on 3 of the bulbs, breaks the bulbs. We don't have any replacement bulbs for them. So we have no lights now.
At realinvestmentadvice.com.
We don't get our kids to do things. We do them ourselves because we want them done.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. So just got done kind of tying up a little bit about required minimum distributions for non-spousal beneficiaries with IRAs. Lots of great questions out there. John did want to cover your question. So if you ever want to ask one, go to YouTube, Real Investment Show. Go hit the subscribe, hit the like button, please. But happy to try to address what we can while we're live. We can always take it offline as well, get you set up with somebody. But the question was, can you give a child a one-time lump sum in your lifetime more than $18,000 a year for a gift? And this is a great question. It's something we actually see come up quite often.
Right.
And, as you're trying to help children as they're, building their life, looking at utility of funds, is it better for them to inherit funds, later down the road when you pass, or maybe as they're, building the foundation of their own financial success and kind of what they're trying to accomplish and growing families. So, Matt, I think you're a good one to address this.
Okay, I'll give it a shot.
Yeah, you got it.
First of all, I'll start with the the one thing that I try to be careful of is there's things out there that get the headlines, right? And one of them is death tax, right? Nobody wants to pay death tax. The fact of the matter is that where your lifetime exclusions are, how much money you're allowed to give away in your lifetime, 99% of people are never going to face that. You know, right now it's about $13-14 million a person that you can give. That's going to go down if the laws aren't changed, and we know laws always change. But for right now, you know, just say 14 million is your number that you can give away in your lifetime.
And if you're married, that number doubles.
And if you're married, that's correct. You get 2 exclusions because you're 2 people, which brings up the SALT deduction and a whole nother wound that's a subject for another day. But at any rate, you know, the first thing to know is that you can use that whenever you like. And while it is, you know, your money and you want to be able to sustain your lifestyle and you want to be able to, you know, be comfortable in whatever retirement lifestyle you have, in the end, there's also trying to balance, do I leave things at my death to my heirs or do I help them now? And a lot of times the kids could use the help earlier rather than later. The other thing is that there's only so much you can do from the grave, meaning that, you know, not necessarily control, but, you know, you want to make sure that your progeny, as it were good stewards of the funds that, you know, you've worked so hard to save and create. So, you know, helping them while you're still alive can also foster good relationships, and it can also help you make sure that, you know, at least to your mind, that they're making good and wise investment decisions. And I think, Danny, you were talking about, you know, working with a client, and the caveat that client came up with was, you know, each of my kids needs to come and do a financial plan to make sure that they're on track. And that's a good idea. Now, that being said, you know, the $18,000 gift that you can give to anyone, you can give it to Brent here, and anybody on the street, no problem. You don't have to file a 709. 709 is the gift tax return. You can just write them a check and then you're done. If you and your spouse want to gift split, then you each get the $18,000 per year that you're allowed to give to anybody. So you can do it that way as well, and that increases the limit. If you want to go further above and beyond that, you file Form 709, and then the 709 is used to deplete your lifetime exemption. So if you've got the 14 million, just using numbers that are easy to mess around with in our heads, you want to give them $1 million, you'll file Form 709, take the 18 grand off, and then the remainder balance will deplete that 14 million to a little bit over 13 million that you'll be allowed to give at death or in the rest of your lifetime.
Without, you can give more, but the caveat is essentially that you're not going to have that additional 40% tax on anything above that estate tax number.
Right. And you know, one thing just to point out, and again, most people don't ever hit that number. I mean, 99.9% of the population are never going to hit that. Even if it goes back to 5 million, most people are still never going to hit that because a married couple's got $10 million that they can pass. And you're talking about a vast majority of the population never even get there. But, you know, just as a distinction, if we say, and we know it's 40% on the high end, but let's just, again, I like simple math. So let's say that the top rate on estates is 50%, and the estate return and the gift return or the gift rate is exactly the same. So there is a difference in the way it's calculated. Is it better to give that if it's a taxable gift or a taxable inheritance? Is it better to give it at death or during my lifetime? Well, it may be the same rate, but it's calculated differently. So if we say I'm going to give $1 million taxable right now, right? What I'm going to do is I'm going to give somebody $1 million, and then the gift tax is going to be 50%, so $500,000. So the total outlay that I've got to do is $1.5 million is that total gift. If I want to give that $1 million at death, and the tax rate's 50%, I have to leave $2 million in my estate, not 1.5, $2 million, because that $2 million gets hit at 50%, and then the beneficiary gets $1 million. So even though the rates are the same percentages, the way that the rates are applied, if you reach that point where you've depleted your exemption, it's better to give in life than at death for that very reason.
Yeah, and I think, you know, we talk about this a lot. Like, what does the utilization of funds look like? If you have somebody starting that family, is it better now? But also, if you're looking and you're saying, you know what, I'm not sure how responsible my kids are going to be. And I'm not sure they're going to be prepared for this. Sometimes it's a test run, and you get that trial run where you're saying, okay, you know what? We're going to give you X amount every year to try to just get you guys on your feet, give you a little bit of a head start. But then you can watch and see what they're actually doing with it. We have a lot of clients that as they do so, they bring them in to say, hey, either we're helping them with financial planning, giving them some advice around what is the best thing to do? How do you get started? Take advantage of employer benefits and really begin to build that foundation. But at the end of the day, you can see, do they go spend this on something frivolous, take a huge trip, or are they saving it? What are they doing? How are they doing so? And because, I hear this often, I get a call every so often where, my kid's doing this. Can you believe it? I'm not going to give them any money. When I'm gone, these funds are going somewhere else. And you're like, okay, all right, let's talk through it. And, you find out, well, they're doing something that they just didn't approve of. And sometimes it's not all that bad. And you say, well, take a step back. If you go at it this route, what's going to be the end game here? And what's that relationship going to look like? But if you're gifting along the way, you can start to see what they're doing. And, I would encourage conversations around this. And we've talked about this where our most successful clients and families in general, and you talk about, generational wealth, and, it starts at the top where you think, everybody thinks about the big families that, have multifamily offices and they're, they've been around forever. People, big name comes to mind like Rockefellers, like how the heck these guys have so much money? And well, it was good planning all along the way. But we see families with much less in wealth. But what happens is it ingrains something in the kids. It's teaching them something that, unfortunately, school's not going to teach them. We're not teaching personal finance 101 anymore. And that's a big, big problem that we have with our education system. And, most kids get out, don't know how to write a check, have never seen one. Not that many people do that these days anyways. But balancing a checkbook is a lost art. And that's just, going back and understanding what you're spending versus what you have coming in. And, that's one of those things where I think that you can use this as a tool to help shape them, give them direction, and help them to get a better understanding as far as how these things work. What are the other things they need to be thinking about? I mean, how many times do you visit with somebody and they're older, never done an estate plan?
No. And I advise clients, I'll say every time, I don't like to use absolutes, but I'll just say every time we do an estate planning discussion and help clients try to figure out and navigate that course in terms of what do they want to do at death. And believe me, I understand that nobody really wants to deal with that. It's never a pleasant topic, but it's got to be addressed. And I tell clients every single time, the most important thing you can do, and I understand that this is difficult and it's hard in a lot of cases, is talk to the kids. You don't necessarily have to say, here are the dollars involved, but here is how I see things going. Here is how I want things to run. Because, families will split up over a ton of money or no money. It really doesn't matter. What at the end of the day makes it all better is the communication. And when we're working with families, we at times help facilitate that. We work with, sometimes 3 generations of family members to try to, have those or facilitate those discussions. A lot of times, especially, you think about people that were raised up during the Depression and, now most of them have passed away, but those people were typically very close to the vest with what's my financial positions and just didn't talk about it much with their kids. And then that, got ingrained, it got passed down. But those open lines of communication really do a lot, because there's only so much that can be divined from a document, right? If you never have these discussions, you pass away, and all of a sudden this document is produced and it comes out, and you're surprising the next generation. There's waves that are generated typically with that kind of setup, because nobody knows what you really meant. So you can have the discussions now. It's important to have the discussions now, and it's difficult, but I really highly recommend doing that.
I do as well. And just remember, they're not always going to go as you would like, right? I mean, I've had somebody in the past send a note or give me a call and be like, you said to go have this discussion with my kids or my parents. It didn't go well at all. Yeah. I'm like, well, and that's part of it, right? We understand that, but having that and putting that up front now certainly helps later. So there's not this uncertainty. You get a very good understanding. So John, I know we went on a tangent here. Hopefully that answered your question. We're going to try to get to donor advised funds and private private charitable foundations. But if you have questions, we may answer those. So we'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. So Brent is formally accepting gifts. Yeah.
Just make the check out to cash.
That's right. That's right. No, you know what? I think, great conversations to have. Always a difficult topic to, especially kind of, have that initial conversation. And, you see that a lot of times around the table at holidays. And this is a great time to maybe bring that up, bring the mood down a little bit. No, I kid. But, things that I do think when you have everybody in one space, just kind of saying, hey, is there something, that you wanted from us if we're not here? And a lot of times you may find out it's not what you think. But want to kind of move on to private charitable foundations and donor advised funds. A lot of talk around that right now. Obviously, people kind of last minute trying to get these things done. We have a lot of clients as well looking for what are other ways that we can reduce our overall tax burden. This can be a really good tool to use, especially when you have a really high income year. And so, we talk about overfunding these types of products in an environment where maybe your tax burden is really high. You've done a large Roth conversion. You're just trying to bring down your overall tax bill. But I'm going to throw a little bit of a curveball here. Matt, what if taxes don't go up? Standard deduction is reduced in half. Somebody may be better utilizing some of these deductions further down the road and actually itemizing than potentially, kind of bundling or bunching, putting all these funds in at once and distributing them over many years. You may be better off waiting a bit.
Yeah.
And that's the trouble right now, right?
Right. Well, things are going to change. This magic 8-ball that we've got here, I don't know that it's any more accurate than I would be predicting whatever the future is going to be. But rates change. They just do. And, talking about when I mentioned about, top line numbers or headline grabbers like death tax. Oh no. A lot of folks will talk about the tax rate, and then they forget exactly like you're talking about, Danny, what's the deductions or what's the other caveats, right? I mean, way back when under Reagan, tax rates had a cap about 75%, but you could deduct pretty much everything you wanted: credit card interest, all sorts of stuff. Passive losses could be counted against active income, which is something that you can't do now. You had a whole bunch of deductions. So there's what's the rate, and then what's your marginal rate or what's your effective rate of taxes that really matters. What's the net number to you? So you might be in a 30% bracket and then have an effective rate of 11. And that's where the rubber kind of meets the road. So do deductions make sense now? Do they make sense later? Do I fund this or do I don't? There's not a lot of clarity that I can give about what the future is going to be, only that they're going to change it. And when they lower that top rate that grabs that headline and they say, oh, well, we reduced rates from 40 to 37. Isn't that great? But we also took away a bunch of these deductions, which gets back to the SALT that I mentioned before, right? It used to be that.
Tell everybody what that is.
Well, so you get to deduct state and local taxes, SALT deductions. But what they've done is that where you would take your property taxes and like if you bought a car and paid sales tax on that, and there's a table that you use based on income for sales tax in general. And like you'd lump all of this local taxes in and get a deduction. And with the changes that happened in 2020, they capped that at 10 grand. So if you go over that, it's too bad for you, right? And so what even rubs me wrong about it even more is that I get that because I'm single. But if I'm married, I still get 10 grand. I don't get 10 grands because I'm married. I get one. Yeah. So they've lowered the headline grabber. The tax rates go down. Isn't that great? But now you can't deduct as much stuff. So it in the end for most folks it becomes a wash. So what do you do? Back to the main question. What do you do in terms of giving money to a charity? The thing that I like about donor advised funds, or whether it's a foundation or whatever it is and getting back to the estate planning piece, those can be used as a family dynamic, right? We talked about, maybe a parent wants to instill certain traits or ideas in the next generation when it comes to money. And what better way than to get together ever so often and say, hey, look, I really like this charity. I like this church. I like this scholarship fund. I like this whatever. And I want to give them some money. And the donor advised fund or a foundation allows you the freedom to not only put a bunch of money in and get a shotgun blast of a deduction now, because you're able to put all of those funds in today and get the deduction today and then stagger out those payments over time. But you're also able as a family to come together and say, hey, look, I want to support this cause and I want to support that, and have a discussion around, supporting the community, supporting your intentions, supporting your causes. So they can be great. I'll caution, though, the issue with private foundations is they can be expensive to run, and you don't get the same amount of deduction in terms of credit. You don't get the same amount of credit back on your taxes. A private foundation, and I don't have the numbers in front of me, but a private foundation gets a less of a credit than a public foundation might get. So the donor advised fund is really for, I think, most folks, probably not only the easiest and most efficient way to manage money, but it just makes sense because it takes a lot of the burden off. There's a form for charities that they have to file a tax form called 990s. If you've got a public charity and you want to see, how much do they spend on overhead, meaning salaries versus actually on the cause, you can go pull the 990. It's a public document, and you can say, 10% of my money is going to programs and 90% to salaries. You can do that math. And those are very onerous. They require a lot of accounting. They require a lot of work. They're a pain in the bottom to go and push those through. So
yeah, there's a handful of resources you can go out and look at, like Charity Navigators one. There's a couple others that you can actually see where they'll have those forms there, and they'll grade these organizations, and that's a big deal. When you see what they spend their money on and where your money goes,
right,
that may persuade you to do something different sometimes, or it may encourage you to give them more.
Sure. Yeah. And the donor advised fund, though, what it'll do is that, from the technical standpoint, I think everybody that's listening now knows that, our preferred custodian is Fidelity, so I'm going to pick on them. Fidelity has a donor advised fund. And what happens is that fund, the Fidelity Donor Advised Fund, is the charity you're giving money to from a technical standpoint. You're putting, you're going to give $10,000 a year for 10 years. So now you're going to take $100,000 and just give it all at once. You are going to get a letter from Fidelity Charitable that says, thank you for your donation of $100,000. And that's how you get your deduction now. And as long as the charity that you want to support over time is a qualified 501c3, then it's basically a transfer between charities. The monies go from Fidelity Charitable to Charity XYZ. And that's how the legal side of it works for those who care. But you manage the money. They've got a suite of investment options in the portfolio, just like a 401k would. You manage that. I don't know, Danny. I think if it's over $250,000, then you can basically do whatever you want. They open up the platform to let you allow you to buy stocks, individually and things of that nature. I don't quote me on that, but I think that's the way it works.
I think Fidelity Retail and Fidelity, what we work with, is a little bit different, where you can actually have them physically manage the funds, or we can manage it, or you can go out and choose what you want to have it in.
Okay.
But I'm not sure on the retail side how that exactly works.
Yeah.
But, that's the thing. You need to think about, what would you donate to that? And you mentioned donating, okay, you're going to give $10,000 for the next 10 years. Why would you donate $100,000 to you this year and not get the deduction in the next several years or next 9 years?
Well, just because of the way the tax law is written, that $10,000 over 10 years probably won't matter to your taxes, right? You get more effect on your net. Again, going back to what's your effective tax rate, you might get more bang for your buck. And you can do side-by-side comparisons in different tax softwares to try to figure this out. Your CPA should be able to help you run this kind of math. But, which way is going to be the most efficient for me, you can plug that in and find out. And again, always the caveat, Danny, is back to your point. These laws change all the time. So I can't predict what it's going to be, or is it going to be different in the future. The only way that we can effectively plan is based on what we do know now. And the way the tax law is written now and the changes that are about to come in place is that tax rates are going up, right? That's just how it's legislated. So, again, CPA is always the final word in terms of is this right for you or not? But that's the reason why you want to sort of what I call front-end loading these gifts. And bringing it back to the original part of this discussion, which is the RMD side, if you find yourself and you say, hey, look, I'm at that age where I'm required to take money out, but I'm still working, or I've got a pension income, or whatever it is, I don't need that money. You can take that RMD and give that to the charity, give that to the donor advised fund.
Up to $100,000.
Up to $100,000. It doesn't count as a gift. You're not going to be able to use that as a tax deduction the way you would if you wrote a check out of your checking account. But what it does do is it takes that money off your top line. So it just never hits your income taxes. So instead of reporting that $100,000 as income, it just doesn't show up.
Yeah, great points there. And I think that, this is something that you should look at if you have a very high income year, you have a liquidity event, you're doing a large Roth conversion, whatever it may be. And maybe next year or the following years, you're not going to have nearly as much income. It can be a great tool in the toolbox. I just realized Brent claimed we were going to talk about looking ahead to 2025 and markets. So let's see, what do we got here? Here's our magic 8 ball. Is this year going to be a great year? Without a doubt. Or 2025. Look at that. All right. Thank you guys for joining us today. We'll continue to try to get to your questions each week. Don't hesitate to reach out, realinvestmentadvice.com. Hey, go sign up for the Economic Summit. I know you guys hear the ads. Going to have Adam Taggart, Lance Roberts, Mike Leibowitz, the whole crew here. Realinvestmentadvice.com. Thank you guys. Have a great weekend.